My name is Therese McGrath. Don't know about the rest of you, but the last 12 months for me have felt like an endless road trip. I've got the noisy kids in the back, kicking the back of the seat, going, are we there yet? Are we there yet? It has been a long and a bit of a difficult journey for us all as we've tried to navigate our way through the current macroeconomic conditions. Globally, inflation has continued to rise. In Australia, we have seen fairly persistent inflation. This has been driven off the fact that we've seen our goods inflation come down, but services, Netflix, travel, entertainment continues to drive inflation forward. And so it has been a difficult path. What's happening in terms of interest rates? Because it has felt like 12 rate rises is a very, very blunt instrument to apply. But you have to remember that interest rates are being used to try and control the inflationary trends. Australia actually has a slight benefit versus the rest of the world in that the majority of our loans continue to be variable. In a number of countries offshore, the length of a mortgage is 10 years plus. So when the Reserve Banks use interest rates as a way to try and control and bring inflation back by diminishing customers' purchasing power, in a variable market, it can work. Now, this is one of the reasons why we've actually seen our inflation rate slightly below the rest of the world and taper, and importantly, why we've also seen our current interest rate not rise as sharply, because the variable rate curve has been able to actually temper some of the noise. And in this environment and what we've been going through, it's not surprising that consumers really are feeling the stress points. But what else is going on for consumers, for your customers? We're also seeing mortgage costs increase. So versus 12 months ago, mortgage costs, that's the amount of disposable income that's going to actually fund mortgage costs, has increased 7%. Alongside this, savings ratios have really come down. At the peak of COVID, people had 20% saving ratios. That was June 2020. It has come down to 3.7%, and that is actually below the long-term average of Australia. We normally run around the 5% mark. So people are eating into their savings and using it as a bit of a buffer for inflationary pressure and increased interest rates. Likewise, real wages are not keeping up with inflation. So what you tend to see is wages are rising at a lower rate. Inflation continues to be accelerated because of the service element. But it's not all doom and gloom, guys. There are some positive shoots, and the most important positive shoot, or the most important positive indicator, continues to be unemployment. 3.5% unemployment basically means anyone who wants a job can get a job. And if people have income coming in, they continue to be strong. So, with that noise going on for consumers, what does it actually mean for lenders? What we are seeing universally across the industry is that low funding costs that we experienced during COVID, like the low interest rates consumers had during COVID, have gone. And we've returned back to normal. We have returned back to the long-term average. So consumers saw, interest rates, or the OCR from the Reserve Bank of 10 basis points during COVID. We're now at 410 basis points. Funders have actually seen funding triple over the period and go back to the long-term average as well. So just as consumers are having pressure, lenders are having pressures as well. And just as we are seeing these economics play out and a tightening of our profit margin across the board, likewise for borrowers, the road is going to still be bumpy. So, 12 months ago, we thought we'd be out of it. I think we've still got another 12 months to go. Borrowers are going to continue to see higher mortgage costs. You cannot assume that interest rates, OCR, will go back to anything like it was during COVID. Interest rates are going to tend back to the long-term average of 300 to 400 basis points. That is the new norm. That is the OCR. I shouldn't actually say it's the new norm. It is the old norm. Likewise, Australian households do continue globally to be amongst the most indebted. So from a balance sheet point of view, there's a lot of debt sitting there. Spare cash is actually dropping for most people. We saw that with the with the savings ratio being down at 3.75%. And likewise, so many of your customers and you personally could be facing into what everyone's calling the mortgage cliff, that movement from fixed to variable rate. And then likewise, we all get a bit excited about rising house prices. It's a good thing because it gives people confidence, but it's also a little bit of a negative thing because rising house prices is coming about because the supply is so low. And as a result of that, we're seeing service inflation be pushed a little bit as well. So, do you think we're going to avoid the R word? I actually mean recession. Yeah, I think we will. I think there's some good shoots out there. Unemployment is key, guys. We continue to have such low unemployment and very high participation rates. That means people have money coming in the door. Very positive. Immigration is a positive as well. Having people come in stimulates demand and will stimulate growth. With our unemployment being so low at the moment, it's impacting productivity. Getting people back into the country and getting back to growth is a positive thing. We sort of said savings ratios are low, but the household balance sheet is very healthy. It is very good. People have equity in their homes. And importantly, China is reopening. That will see an influx of international students. International students contribute 1% to the GDP. Likewise, you see a stimulation of tourism, travel, and importantly as well, if China gets back, we should see our energy exports increase as well, good for terms of trade. There are some negatives though, or some bumps, which we just need to face into and watch out for. Productivity, productivity, productivity. We are at zero productivity in Australia. To be a developed nation, we need to get to that 1% mark. Or a developing nation, we need to get to that 1% mark. What that basically means is that we need to do more with less. We need to invest in the right ways. We need to make sure we're applying technology, getting efficient and driving productivity. Productivity is the one big thing you're going to hear from the Reserve Bank that is holding the country back. So really think about your productivity. Household income as well, bit of a wobble coming up. We are asset rich, but we're a little bit cash poor, but we can balance that. And then likewise, inflation is going to continue. It's going to be a little bit of time before we're back into the target range that the RBA has set, but we can do it. Brokers have never been as important as they are today. Banks have walked away from the high street. They have closed their branches. You guys have all stepped in to actually fill that void. Getting a mortgage is a complex financial structure. People need that face-to-face support to help them navigate through, to help them cut through the noise. That is your role. One of the things you've got to ask yourself though, are you keeping pace with the market? So the number of brokers have grown, you've never been more important. What's happened to your share? Are you growing that as well? So one way to do that is to think about your value tree. What are the levers that you all can apply to profitably grow your business? This is a live model within our business. And what we do is we take all of the revenue streams and we go, what's driving that? What is the lever that will drive that revenue? Number of applications, prime versus non-conforming. Is it, broke BDMs on the street, the number of calls that they do? We break it all down and we understand the contribution from that driver and how much it can actually help drive both revenue. Importantly, you've got to do the same on the cost side. Sit back and say, okay, do I want to invest in technology to get a better yield per BDM, per relationship manager? Or am I actually happy to build the number of people I have? Which is the best lever for me to apply and to drive? So you work your way through your P&L. You think about your key drivers and you think about how hard you can pull that to drive revenue or get costs out, to drive efficiency, productivity and growth.